Okay, so in the next section, we'll get into how to put a value on any company you're looking at. It's really very easy to understand following the formula, and you could jump to that lecture if you want, but we're still laying the groundwork with these lectures before because we do think it's very important. So we urge you to continue these lectures in sequence. Once you figure out what a business is truly worth, you need to determine if it's possible to buy shares of that business at a discount. Do stocks easily sell for bargains? Can you buy, to use the earlier analogy, $100 bills for $50? And even if you can you then buy the good companies on sale like that? Well, absolutely. And you can do this again and again. We've been through a few examples of this already. Before we get into the reason of why you can, let me first try to convince you that you actually can buy $100 bills for $50 in the stock market. Let me show you that prices really do move in almost any stock on the market, and they move quite a bit. We like to illustrate the oftentimes out of whack prices in the stock market by looking at the highs and the lows for the year of any particular stock. It's astounding how much the prices move over time. A lot of people don't actually realize this. Really, almost any stock will illustrate our point for us. This is just a demonstration to show you the volatility in stocks and how much they really do swing, potentially giving you opportunities when you're looking for them. As a side note here, I'm not saying anything about the value we're placing on any of the stocks that we'll show here, or if they were a good deal at the time. Some of the ones you'll look at went straight up from low to high in the past year. Others went straight down from high to low, while others bounced back and forth. It doesn't matter. I simply want to show you that the prices really do move a lot, and that the price in the market very frequently does not represent the true value in these stocks. And most importantly for you, that there really are countless opportunities to take advantage of. Okay, so if we were in an individual market, in an individual meeting right now with a client where you could talk to us, I might say something like, give me the name of your favorite stock, or list off 5 to 10 companies you want me to take a look at here to illustrate these points. But since we can't hear your feedback on the other side here, we'll pick a few for you. So let's start with Starbucks. We'll take a look at that one. So it says here that the current price of Starbucks is $57.48. That's for one share. And the highest price Starbucks shares sold for over the course of the last year was $59.32. The lowest price was $35.39. So the difference here between the low price and the high price was 68% in 1 year. That's probably a bigger swing than you realized. Okay, let's move on. Walmart. All right, with Walmart, you could have purchased one share for $64.27 as of today. Yet in the last 52 weeks, in the last year, you could have bought it for anywhere between $61.50 and $90.97. That's about a 48% difference in just 1 year. Now, let me ask you, does the value of this multinational brand, Walmart, really change by that much in just 1 year? Hint, no, it doesn't. Disney stock, let's move on to that one. Disney's been a popular company over the last few years with their success in movies and theme parks soaring. They're currently available at a price of $102.67. In this last year, their prices range between $78.54 and $122.08. Now, that's quite a range. That's a 55% difference in 1 year alone. One or both of those prices was not in line with their value. Okay, how about Nike? Nike is at an all-time high right about now. You can buy one share for a whopping $123.83. However, in the last year, you could have snapped up their stock at a low of $83.85. Their high for the year was $125.95. This is a 50% difference for a global shoe company worth billions of dollars. Did they sell 50% more shoes in the last year? Or is there some discrepancy between the price and the value at some point there? We can keep going. Some of you might say, yeah, but in this last year, this was in a bull market, an upwards trending market. Everything went up. And that's true for the most part. In the last 12 months, stocks have done pretty well. But take a look at some of these price swings that happened during a large up market, yet went back and forth, giving smart investors the opportunity to profit big time very quickly. Okay, Lululemon. Some of this one, some of you might not know, but Lululemon's price has been swinging between $37.86 on the low end and $70 on the high end. This is per share over the last year. Right now, you can get it for $50.28. The difference here between the highs and the lows for the year was almost 85%. They started down, went up, and have since come back down a little bit. Big time opportunities at each point, and a surefire mismatch of price and value. Sprouts Farmers Market is a locally based grocer from my hometown in Phoenix, which recently went public a couple of years ago. Their swing, I believe, has been even bigger than any of the others we've looked at, and it's been up and down in the last year. They were at a low here over the last 52 weeks of $16.41, but they got as high as $38.45. Right now, they're selling for $21.10, somewhere near their 52-week low. Their 52-week difference was over 134%. So all of these examples just goes to prove that the price in the market of any particular stock at any particular time does not necessarily equal the value of that stock. Like I said before, many stocks across all industries will illustrate this point that I'm trying to get across here. Stock prices swing. They swing up, they swing down, and they swing back and forth. But what's the point of all of this, you might be asking? It means that you can buy companies on sale. It means that there are huge differences in price in the stocks of major companies from month to month. It means that the market gives you all sorts of opportunities to capitalize on these price differences in any type of market over and over again, as long as you know how to do it, as long as you know how to take advantage of that. That's good news for you. All of those examples show a wide range of pricing across just 52 weeks. And that's just 1 year, the most current year. We aren't picking and choosing the best times here. We're just looking at the last year. The same could be shown for any type of market. Keep in mind, this is actually a pretty normal fluctuation that we run across. If we expanded our search to look at highs and lows for 3, 5, or 10-year swings, this range of prices would be absolutely enormous. This is a tremendous opportunity for you as a smart investor. But how is all of this possible? How are these price swings possible? Does the underlying true value in these businesses really swing that much in a single year? Think about it. These are large companies. Billions and billions of dollars are involved here. Hundreds of millions of shares are involved here. This isn't some small speculative game we're looking at. This is real business and real markets. Big business. People are all over the world trading their individual shares of these businesses that we just looked at every day. Why do these stock prices have such wide ranges in such a short amount of time? Is it truly indicative of their value? Just to go a little further with this explanation, let's look at what it means in real dollars. Sure, prices in a stock per share can swing by 50% or more in a given year, but what does that really mean? Okay, let's take a look at Starbucks again. The current market price or market capitalization for the full business is about $87 billion right now. Their business is divided up into about 1.5 billion equal shares, and these are called shares outstanding. This means that when they were selling for $35 earlier in the year on the low end, the market was valuing their entire business at around $54 billion. This is found by multiplying the low $35 share price times their average shares outstanding, which is a little over 1.5 billion shares. On the high end, when they were selling for over $59 a share, the market was valuing them at almost $91 billion. So in just 1 year, their market price swung from $54 billion to $91 billion. This is a massive amount of money in 1 year. and a 68% price swing. How can this be? Does this make sense? Did they sell 68% more coffee throughout the year? Did they cut costs or open huge amounts of stores worth $37 billion this year? No, they didn't. The simple answer here is prices swing for any number of reasons, usually related to the emotions of fear or greed. And lucky for you, as long as you know that, you can take advantage. Now, I don't know if you would have bought Starbucks at its low. It's simply pointing out that this stock has moved 68% in the last year across its two ranges. That's no small movement, yet it's actually pretty typical. Let's take a look at another one. How about Nike? They had a 50% price swing from high to low in the last 52 weeks. At their high, participants in the stock market said that Nike as an entire business was valued at over $111 billion. At its low, they said the entire business was valued at $74 billion. This is Nike, a massive global corporation that's been around since the 1960s. Does their price swing of $37 billion, 50%, in the span of just 1 year, match up to the reality of their value? I really don't think so. One of those values is off. At its high price mark, Nike was either way overpriced or it was a real steal when it was priced at its low point. In either case, when talking about Nike specifically, there's simply no way they increased the value of their company by $37 billion in the span of just 1 year. And even if any particular company made sense as far as the wild price changes in a short time frame go, because they do for some individual companies, is there something that accounts for the large changes in all of these companies every single year? Why do most companies we look at have such wild price swings? Because if you do the same tests, you'll find roughly the same results each year, and bigger swings if you look over a longer time frame. So ask yourself, does this make sense? Is it accurate that the value of all of these companies, the value, not the price, large and small alike, are swinging so wildly every single year, over and over again? Does this really make sense? Well, simply put, no, it doesn't. It doesn't make sense. Have we said that enough times yet? The prices definitely swing, that we can be sure of. We're seeing it right before our eyes. But the value is not changing like that. The true value. Nike was not truly worth $74 billion one day and $111 billion the next. At least one and possibly both of those numbers are not in line with their true value. And when we have a discrepancy between the price and the value, we can make money. When we know the value, we can make even more money. When we buy only when the price swings down to be lower than the value, we have quite a successful stock investing strategy. So I hope this all helps to illustrate the enormous opportunity being able to accurately value stocks gives you when it comes to making big money in the stock market.